We have a wonderful guest. Danisha is from England, London, and from our sister organization that has grown past us, Positive Money. And we'll get an update now with a few different things happening in England. And just so you know, Danisha, we had Edgar Wortman speaking about what's going on in the Netherlands. But if you could tell us a bit about Positive Money, Bank of England, and how Positive Money is putting out some effort, we'd like to hear. I give you the floor. Thank you.
Thank you, Stephen, and thank you, Howard, for amazing, very creative and brilliant song. Hello to everyone. So my name's Danisha, and I'm at Positive Money in the UK. We're a non-for-profit research and campaigning organisation working at reform of the money and banking system to make it fair, democratic and sustainable. As Stephen mentioned, I'll talk about a few of the trends happening at the moment, some of the work we're doing on monetary financing, and some of the developments taking place in the UK due to the pandemic, mostly at the moment. I'm also going to mention a little bit about digital currency and central bank digital currency, and a little bit about credit guidance. But
excuse me, can your mic be improved so that we can hear a little clearer? Yeah.
If I come closer, can you hear me better now?
Yes, it's a little better.
A little better. Oh,
that's good. That's good.
Yeah.
Almost.
Okay. For the past 10 years, Positive Money has been mainstreaming the idea of direct monetary financing. And in this respect, there's been really unprecedented action by central banks and governments around the world at the moment. Most recently, the Treasury and the Bank of England have been engaging in monetary financing to pay for substantial increases in public investment and spending, in response to the crisis, the COVID crisis. So this year, there's been 3 rounds of quantitative easing since March, totaling 450 billion, of which 440 billion was gilts, the purchase of gilts, and 10 billion was corporate bonds. This takes the total of quantitative easing operations since the global financial crisis, since 2009, to almost 900 billion in the UK. So quite a lot. So the Bank of England has generally distanced all of its rounds of quantitative easing from the idea of it being monetary financing, insisting that it is purely a monetary policy operation to keep real interest rates down for the private sector. But what we've seen in this year, in March, that there's a lot more coordination between the bank and the Treasury. So we've seen that every time there's an announcement to expand quantitative easing by the Bank of England, we've seen that literally the next day, the Treasury has announced a spending programme in response to the crisis. So specifically on things like the furlough scheme in the UK, which was our scheme to support jobs during the lockdown. And there's been some much more sort of clear coordination going on. The bank sort of does continue to distance itself from this idea of monetary financing, partly saying that any quantitative easing that's taken place will be temporary and it will be reversed, and government debt will be sold back to the market. However, we've seen, like I said, much more coordination on this front, but we've also seen that not a single pound of QE has ever been reversed since 2009, and it's very unlikely to, where interest rates are extremely low, ultra low for most developed economies. So our position is that the Bank of England is effectively monetizing large amounts of government debt, and we want it to be more open about the fact that it's using these unconventional tools and policies, and open about what potential these tools and policies could have. QE has increasingly been argued to be hitting some of its limits of effectiveness now. The Bank of England owns 44% of the outstanding government bonds, and it has a self-imposed limit on that, rising to 70%. So beyond 70%, it doesn't want to continue buying bonds. So this has led to a lot more chatter in the world of finance about the bank using negative interest rates in the near future, or possibly switching to a policy of yield curve control, which the Central Bank of Japan does. But our argument would be to highlight, and this is what we've been doing, is to highlight that we have been doing monetary financing indirectly through QE, and we should switch to more direct monetary financing rather than these kind of other distant policies such as negative interest rates or yield curve control. And this is because the potential for coordination on monetary and fiscal policy by the Treasury and the Bank of England has potential to raise large-scale funding that we need for important shifts in our economy, such as a green transition, a green jobs guarantee. Universal basic services are better supported in the UK than they have been, and avoiding the looming unemployment crisis from COVID. In terms of direct monetary financing, we've generally argued for the two possibilities that there are. That's the government to use the Ways and Means facilities. That's basically the word for the government's overdraft at the Bank of England. We want them to use that, and for the government to purchase, Bank of England to purchase government debt directly from the government, from the primary market, rather than through secondary markets, which is what quantitative easing is. Direct monetary financing, we argue, should be a common feature of monetary and fiscal coordination in a post-growth economy. We believe that this would give the government more power to finance important transformational policies, and also, very importantly, not be dependent on financial markets for its spending. The Ways and Means facility was extended in April to the government to an unlimited amount, but the government has not taken advantage of this, and it remains at a flat line at 370 million, which it was in 2009, and it still remains unchanged. So they're not making use of it. So we would argue that they should be taking full advantage of this to support public spending. And we sort of argue that with the right institutional checks in place and the Bank of England in control of the scale of direct monetary financing, there should be no fears about excessive inflation or any other adverse effects. So that's the monetary financing side of things. We basically argue for more direct forms that will bypass financial markets and mean that we can spend directly on transforming the economy to the benefit of sort of social and environmental objectives. So moving on to central bank digital currency, just to give you a bit of an update on what Positive Money is doing on that. We've been campaigning for the Bank of England to create a central bank digital currency to ensure and protect public access means of payment, but also to ensure the design and the implementation of it is in the public interest and will avoid any potential risks to financial instability. So far, the Bank of England has not made a decision on what it's going to do with the central bank digital currency, but it has indicated it is researching it and looking at all the different options for its implementation. Back in April 2020, this year, we released a report called Money We Trust, which assesses all the different aspects of a central bank digital currency and how it could be implemented to avoid some of the potential risks of it. Now, with the risks of it, I'm sure you guys will know, but just to recap, some of the risks are around financial instability in the banking sector. So we could have faster bank runs because it's conducted online. So there could be potential for that. And we also have noted that people worry about competition between a central bank digital currency and bank deposits. So making the banking sector more irrelevant, I guess. And this is called disintermediation of the commercial banks. So to overcome these risks, we've argued, and to capture the benefits of a central bank digital currency, we've argued it should be universally accessible and account-based. So just like cash is universally accessible and it's account-based. And it should be provided through a trusted intermediary, such as the central bank. Additionally, we make the case for an interest-bearing central bank digital currency. And we argue interest-bearing means the central bank can control the level of competitiveness the digital currency will have versus bank deposits. And the bank can provide forward guidance on the rate it's setting so that they can control that kind of competitiveness. And this would limit any bank disintermediation that could happen or financial instability. A significant aspect of why we argue a central bank digital currency should be created is that it would make unconventional monetary policies much more feasible for the bank to implement. So helicopter money would be much more easy to implement via a central bank. That means the money created by the central bank can be directly transferred to the wider economy and to people in a way that quantitative easing is not so direct and goes through the financial markets. And what we know, and we've done work on this with other organizations in this sector, is that quantitative easing have had some negative or adverse effects in terms of being highly unequal distributionally in the economy. It tends to benefit the asset rich and property owners, and also it's had quite limited effects in terms of boosting effective demand and economic growth. So we believe central bank digital currency could have more direct effects through unconventional monetary policy. So the final thing I'm going to talk about is credit guidance policy. Now, this isn't something we've done separate work on, but it often falls under other aspects of our work as a policy we advocate for. It falls in line with our work on greening central banks and on the financial sector more broadly, and also in terms of implementing a just transition to a net carbon zero economy, and adopting monetary financing for transformative social and economic objectives in the economy. So here what we've argued is that there's a strong economic case for aiming to influence credit allocation in the economy and distribution of bank lending so that it benefits society rather than just the asset rich. So what we know from the global financial crisis, obviously, is that risky bank lending was a major blind spot and the cause of financial instability. And we believe that the Bank of England has a lot of tools in the toolbox and levers to influence how credit is allocated in the economy. This includes sort of credit ceilings and quotas, interest rate ceilings, collateral framework requirements, and targeted refinancing operations. We say that we've sort of argued in a recent report that the current mandate of the Bank of England is too narrowly defined on financial risk in the financial sector, and it should be more aligned with financial stability that is has a mandate for broader social and environmental objectives. We do recognise that credit guidance policies have distributional effects and directional effects in the economy, and these could change over time as our objectives, our social and environmental objectives change. So what we've also said is that this sort of credit guidance, institutionalising credit guidance, should come in coordination between the Treasury, which is an elected body, elected with a mandate, and with the Bank of England to make those policies more democratic and accountable. So yeah, that's me. Those are the sort of three areas I wanted to talk about. We also do a lot of stuff at Cost of Money on growth being more, you know, we've done some stuff, a report on the tragedy of growth, that degrowth should include shifting our economy to prioritising well-being of people and the planet. So we've done some stuff around that. But our main thing is direct monetary financing and expanding the tools that the Bank of England and the Treasury have to spend on transformative policies.
That was a whirlwind, Danisha, and you did a fantastic job. It was, but while we have you, we do have a few little quick questions, but just on this side of the pond, as they say, in the U.S., the Federal Reserve and the Treasury here have worked on getting around the bond market here, so that and all of this money is to work with misadventures in the banking system. I'll put it like that. consolidated loan obligations, they call them this year, instead of other things.
Right.
And could you say something a little bit more, because we would positive money is more forward. You know, in the US, we've concentrated, we're spreading out into the Green Party, and we're very strong there. And we're trying to make some connections with the rural community to bring rural and urban people together. There's been a lot of suffering in that relationship and among rural communities. So can you tell us a little bit, like, what does post-growth economy look like? And if you have any thoughts about rural areas in England too, are they suffering more than urban areas? So post-growth, and any thoughts on urban versus rural?
Yeah, so post-growth policies, what we're talking about are sort of probably two kind of categories here. One would be very much the sort of policies that would transition us to a net carbon zero economy. So shifting away from fossil fuel use, from shifting to sustainable energy sources, retrofitting houses so that they're green and not energy inefficient, shifting a big part of it that I don't know about in the US because we have a slightly different system in the UK, but a big part of it would be supporting much better our NHS, our social care services that are universally, the welfare system is accessible, but it's been underfunded, especially in the last 10 years because we had austerity. So we want to protect that much more. And coming out of COVID, what we saw were key workers in public health, in even, you know, like on the garbage collectors, education, the teachers, all these essential workers weren't being supported and their sectors weren't being financed well enough. So we would see that as post-growth policies, protecting the healthcare, the social care sector, and a range of policies to shift us to green technology and green energy sources, and creating jobs in those sectors is very important, especially because of COVID. People are losing jobs at the moment, and there are big shifts in terms of people's consumption patterns are shifting online, so the high streets are shutting down, and with lockdowns happening every so often, it means a lot of our sectors are just changing shape entirely. There's another element to that in terms of post-growth policies. We just want to focus much more on well-being, which sounds a bit wishy-washy, but the idea is that we focus more on not just growth for growth's sake, or to have the highest GDP because it's competition between all the countries in the world, but we focus more on the well-being of people and the planet. So that would be in line with post-growth policies that we advocate for. I think the thing about rural and urban, it's probably very different to the US. I know your agricultural sector is quite a lot bigger than ours, I think, so it's a bit different. I would say the divide really came out in Brexit. So Brexit really brought to the fore industries such as fishing and the food industries that we have. And that's where the divide became very strong for us. So the urban sectors, London, the big cities, were benefiting a lot more from the way the economic model is here than sort of traditional industries like fishing. Fishing has been the main one with the European Union that has really demanded Brexit, I guess, is a very simple way of putting it. So that's been probably where the rural-urban divide is for ours. But there's also a north and south divide that's very big. So London tends to get has the financial sector in London, and it gets all the kind of benefits of having a financial sector and a world financial sector where a lot of capital flows through it, and other parts of the economy tend to be underfunded, or the industrial policy doesn't enable financing to go to those other sectors of the economy that are placed in the north of England. So they tend to feel disheartened by that, and that's also kind of a lot of what's led to Brexit as well, probably. Yeah, does that help answer your question?
Yes, it does. And thank you for bringing up Brexit. One more, another question that somebody's raising, and I'll give you a slight background for it. In this country, right around 2011, we proposed the NEED Act in Congress as a bill, and it was our basic bill that Ben Dyson and other people signed on to. And then back in England, 2 years later, there was a Bank of England slash creation of currency bill, which was very much akin to the NEED Act, with some minor differences, but the major thrust was the same. And so the question is there anything going on, and how is your relationship with the legislature? For quite a while, you had a relationship with Martin Wolf, and you were going forward, really making connections with the legislature. But it's a very hard system to change in any country. And how do you manage to keep up with them, or how do you work with the parliament?
Yeah, and in terms of, I guess there's different levels at which this works, but we have obviously a campaigns and influencing team, which is really small. We're a very small organisation. It's like 2-3 people. So we keep pressure up by engaging with the parliamentary system, with the Bank of England. We obviously release reports. We do constant kind of engaging on major topics. I think very recently we did a report on, this probably won't mean much to you, this word, and you'll probably have your version of it in America, but it's called the Corporate COVID Financing Facility, which was basically the Bank of England and Treasury had a scheme to provide very generous terms on loans to large corporations in the UK, large as in really the top layer of companies, and providing loans around 0.3%, 0.7% to these companies, and they're state backed. So if they don't pay it back, the taxpayer will. So these were very generous terms to help them through the crisis, whereas small businesses haven't had this same kind of generous terms of loans by any stretch. So we did a report on that, and we demanded a lot more transparency and accountability on it. And eventually what we got was that the Bank of England had to publish the names of these companies so we could monitor it and check for accountability. We also asked for conditionalities on it. But one thing is we don't do it on our own in a silo and isolated. We tend to have lots of other organisations in our sector that are also working on it. So there's this kind of this movement that works on these things, and it tends to put pressure on the government to respond to it then. And I think that's how the structure tends to work. We do have a lot of sway with the Bank of England. They do trust our kind of position on a lot of things, and they listen to us because obviously Ben Dyson used to work at Positive Money, was set up Positive Money, and then he's also at the Bank of England now. Perhaps it's a much smaller structure in England that means we can have a little bit of influence, combined with other organisations and think tanks working on the same stuff. And that tends to be how we can have that kind of ability to put pressure on the Bank of England or the Treasury. But we just are continuing to do what we do because a lot of things aren't happening as well. So the Bank of England, for example, is still denying that monetary financing is happening. So we continue to put pressure on. We put lots of blog posts out regularly. We put petitions out through supporters. We get we do a lot of responses to parliamentary consultations. We do that very regularly to have our sort of voice heard. And yeah, we just keep putting a lot of stuff out there that's consistent and responds to all of their actions and things like that. Recently, Fran, who is executive director, I'm sure you guys know her, she was called to a select committee to speak on environmental issues and financing environmental issues. So, yeah, I wonder if the structure in the UK legislature parliament is a bit less maybe complex and a lot less large compared to America, which I'm not an expert on, but
Well, the Federal Reserve in America is controlled by the bankers, and it's actually a private membership institution based on bankers' membership, and only at the top is there a little bit of public influence, and there's some accounting influence because there's profits go back to the Treasury, but
yeah.
at Warmth, I've worked with two of the Federal Reserves, and I find that the Federal Reserve, I think during our 08-09 crisis, particularly in Cleveland, in part for a while was just turning its back on the people and didn't have that close relationship that you have in England that came out of World War II when your Archbishop William Temple said, we need to nationalize the Bank of England because what should be the servant became the master, referring to the money there. And but I want to tell you, we're going to push on, but you've given us so much information so quickly. From an American style, you'd be like playing baseball and you've just hit a home run, probably a grand slam. So you were fantastic, Danisha. And if we were all there, we would be giving you big applause, but we give you hand waves now and say thank you very, very much.
I'm seeing questions come up in the chat, and I know your question time is a lot later in the evening, and I don't think I'll be able to join because it's quite late here then. But I wanted to say it's really great to meet you all, and I might pop into some of the talks tomorrow. I can see that you've got some really interesting ones, so if you don't mind, I'll pop in and see how it's going.
That'd be great.
That would be great, and people will be able to directly chat with you then with more sentiments and feelings and questions, and thank you very much for working on the other side of the pond tonight.
Thank you, and I stay in touch, and we want to hear about how your work's going and collaborate if there's ever any possibility. I think it's important to do that. And also wanted to say really congratulations on being able to do your conference online, because it's really difficult to organize these things at the moment.
Well, it was a lot of work, and if you want to get any tips, we've had a good sized team here put it together, and if we could, Positive Money has been such a leader, but if we can give you a little tips on Zoom conferences, we'll be happy to share.
That's great, brilliant, well done, and thank you.
Yes, thank you too.
We will speak again soon, all of us.
Okay, bye-bye for now.
Bye, take
Maybe
care.
see you tomorrow then, hopefully. If this video was helpful, please hit the like button, subscribe for new video notifications. Please consider donating at monetary.org/donate. Don't forget to check us out on Twitter at AMI Monetary or on our website